Welcome back to ActioFin. So far you can read what happened and cost what you make. This episode looks forward. A budget is simply the business plan expressed in numbers. And the master budget is the set of linked schedules that turn one sales forecast into a complete financial picture for the year. Done well, it is the controller's steering wheel. Done badly, it is a spreadsheet nobody believes by March. Let us build one properly. Our plan: first, what a budget is actually for, beyond the ritual. Then the master budget chain, the order in which the schedules connect. We weigh top-down against bottom-up building. We spend real time on the cash budget, because that is the one that bites. We build a worked example with a furniture maker. And we close with the takeaways. Start with purpose, because it shapes everything. A budget does two jobs. First, coordination. It forces sales, production, purchasing, and finance to agree a single, consistent plan instead of pulling in different directions. Second, control. It becomes the yardstick. Remember the control loop from episode 1. Plan, measure, compare, act. The budget is the plan you compare against. Without a credible budget, variance analysis has nothing to measure, and the whole control system goes blind. The master budget is a chain, and order matters. It starts with the sales budget, because almost everything else depends on how much you expect to sell. From sales you derive the production budget and the materials you must buy. From production you derive labor and overhead. All of that feeds the cash budget, which times the money in and out. And finally the pieces roll up into a budgeted profit and loss and a budgeted balance sheet. Break the chain at the top and every schedule below inherits the error. One refinement on where the chain starts. Most of the time, sales demand is the factor that limits the business, so the sales budget leads. But not always. Sometimes the real constraint is a single machine running at capacity, a scarce skilled team, or simply cash. Whatever cannot be expanded in the short term is your limiting factor, and the budget must be built around it first. If a bottleneck machine can only produce 10,000 units, there is no point budgeting sales of 15,000. Find the true constraint, plan it to the hilt, and let the other schedules flex around it. Spotting the limiting factor is one of the quiet skills that separates a real controller from a spreadsheet operator. Because sales drives the chain, honesty there is everything. An optimistic sales budget feels good in the planning meeting, but it multiplies down the chain. You plan to produce too much, so you buy too much material and hire too many people. And the cash budget quietly assumes income that never arrives. By the time reality lands, the commitments are already made. A controller earns their keep by gently pressure testing the sales number. With pipeline, seasonality and history, before the rest of the plan is built on it. Let us watch the chain turn, with round numbers. Suppose the sales budget is 10,000 units. The production budget is not 10,000, because you also want to lift finished goods stock a little. So you plan to make 10,500. Each unit needs 1 kilo of material, and you want a small raw material buffer too. So the purchasing budget lands near 10,400 kilos. From that you derive how much cash leaves to pay suppliers, and when. Notice how a single sales figure cascades into production, purchasing and cash, each adjusted for the stock you choose to hold. That cascade is the master budget in motion, and a wrong sales number distorts every step below. A tip that pays off later: build the budget with fixed and variable costs separated from the start. Using the cost behavior from episode 2. Why? Because volume never lands exactly on plan, and a budget that distinguishes fixed from variable can be flexed. Recalculated at whatever volume you actually achieved. That flexed budget is the fair benchmark for variance analysis in Episode 4. A budget that lumps all costs together cannot flex. So every comparison confuses the effect of selling more with the effect of spending wastefully. Designing the budget to bend is a small discipline now that saves a great deal of confusion at month end. 2 ways to build it, each with a failure mode. Top-down, leadership sets the targets and cascades them. It is fast and strategically aligned, but managers may see the numbers as imposed and unrealistic. Bottom-up, each department builds its own budget and you consolidate. It earns buy-in and is usually more realistic, but it is slower and invites padding. Managers quietly building in slack so they always look good. Most healthy organizations blend the two. Leadership sets the envelope, departments build within it, and the controller negotiates the gap. A quick but important choice: how hard do you challenge the previous year? The default is incremental budgeting. Take last year's numbers and add or trim a few %. It is fast and stable, but it quietly inherits every inefficiency baked into the past, because nobody re-examines the base. The alternative is zero-based budgeting, where each department starts from zero and must justify every pound it wants, as if the activity were brand new. Zero-based is far more demanding and you would not do it every year, but running it periodically, say every third year or on a bloated cost line, strips out the fat that incremental budgeting hides. A good controller knows when to coast on incremental and when to force a zero-based reset. Now the cash budget, the schedule that saves companies. Profit and cash are not the same thing. You can have a profitable budget and still run out of money because timing differs from profit. You pay staff and suppliers on schedule, but customers pay you on 30, 60, even 90-day terms. The cash budget lays receipts and payments on a timeline so you can see the troughs in advance and arrange an overdraft before you need it. Not during the panic. A controller who only budgets profit, and never cash, is leaving the business exposed. Meet Verda Furniture. It lands a large retail contract worth £600,000 of extra sales at a healthy 22% margin. On the budgeted profit and loss it looks like a triumph. But build the cash budget and a problem appears. Verda must buy timber and pay overtime in month 1 to fulfill the order, while the retailer, a powerful customer, pays on 90-day terms in month 3. Profitable on paper, the contract opens a deep cash hole in between. Here is the shape of it. The contract adds a budgeted profit of £132,000, genuinely good. Yet the cash budget shows the bank balance diving to minus £210,000 in the worst month, driven by 90-day customer terms. Because the controller modeled cash, not just profit, Verda arranged a £150,000 overdraft before signing. The growth went ahead, funded and calm, instead of becoming a crisis. That is the cash budget doing exactly its job. 3 mistakes. First, budget once and forget. A plan frozen in January is already wrong by spring. Which is why many firms now run rolling forecasts, our subject in episode 6. Second, budgeting profit with no cash budget, hiding the timing risk that genuinely sinks companies. Third, sandbagging, managers padding their budget so targets are trivial to beat. A controller challenges that slack with history and benchmarks, keeping the budget a real yardstick rather than a comfortable fiction. Everything so far has been the operating budget, the day-to-day running of the business. But there is a second, separate budget that matters enormously, the capital budget. This plans the large, one-off investments, a new machine, a vehicle fleet. A shop fit out, that are not annual expenses but long-term commitments. Capital items get their own appraisal, looking at payback and return, and crucially their own cash timing. Because a £100,000 machine hits the bank in one lump. Folding a major capital purchase into the operating budget, or forgetting its cash impact, is a classic planning failure. Keep the two budgets distinct, then bring them together in the cash plan. Finally, remember that a budget is not a document you file in January, it is a living control tool. Budgetary control is the monthly rhythm of bringing actual results back against the budget. Discussing the differences with the managers who own them, and feeding those lessons into the next decision. This closes the control loop from episode 1, plan, measure, compare, act, with the budget as the plan. A business that builds an elaborate budget and never compares actuals to it has done the hard work and thrown away the payoff. The budget earns its keep every month. In the meeting where numbers turn into decisions, not once a year when it is written. To recap, the budget is the plan your whole control system measures against, so it must be credible. It is a chain that starts with sales, so guard that number. Build it by blending a top-down envelope with bottom-up detail, and negotiate the slack. And never stop at a budgeted profit and loss, model the cash, because timing, not profitability, is what catches growing companies by surprise. You now have a plan worth measuring against. In episode 4 we close the loop with variance analysis, comparing actual to budget. Splitting the difference into price and volume effects, and turning each variance into a clear action. The full course, with calculators and practice cases, is on ActioFin.com. See you in episode 4.